17 meeting of the Zoning and Finance Committee meeting to order. Before doing that, I'd like to make a special recognition for a guest that we have today, a Boy Scout from Troop 596. Would you please stand up so we can all see you? And that's Dad sitting next to you, I suppose, right? And Ben Thompson, Thompson, troop number 596, that is associated with Aquinas Academy down on West Hardee's Road. Welcome tonight. I presume you're here trying to punch a ticket for one of your merit badges, the community service one. Is that it?
Yes, sir.
All of us have family members in one form or another. Most of us, I should say, have family members that are associated with the Boy Scouts. And, it's a wonderful organization. I really encourage you to stay with it. I have a member, a young man in our family who happens to be my niece, my nephew, I'm sorry, who's been very active in the Boy Scouts, and he went on to become an Eagle Scout. And if you can find a time in your schedule and work to do that, it's a wonderful thing to do. You'll never regret having done it. Okay, well, thank you very much and welcome. Item number 2, review a lot line revision for the, and again, there's a case, silent, Niesel?
Niesel.
Yeah. Niesel plan of lots located at 10020 and 10050 Rinneman Road, which is just north of Bloom Avenue along Rinneman Road, as per file number, excuse me, as per file number 35654, sheet 1 of 1, prepared by Tate Engineering, dated February 7th, 2017, with the latest revision being April 5th, 2017. This has been reviewed before by council, and I know we had extensive review at the last Planning Commission meeting. But Bruce, you may want to add whatever you'd like to add right now.
Sure, yeah.
Put it in some perspective for us.
Sure, this is a lot line revision. It's located on Reineman Road, just north of Bloom Road. And this is McKnight Road, Pine Creek, and it turns into Reineman. This is Bloom Avenue. And this is the lot, and the lot which is receiving property, and this is the lot which is giving up property. So what we have David, this is for David Ettore, and David
Excuse me, Bruce, would you pull that over a little? I can't see. Thank you.
The lot in purple is the lot which exists for David Ettore. The lot in yellow is the lot from which the subdivision is taking place. The proposal is to subdivide this lot and take the lot line through here and add it to this lot, so that the new lot will be shaped like this.
So Dave Etor is getting the new land?
Yes, he is. And there, this was, we had requested some modifications to the plan. Those modifications were made and approved by the town engineer.
Do any of all the stormwater questions been answered regarding any?
There, when there's a lot line revision, they're not building anything, so there aren't any stormwater issues with
The
associated
issue I
with this.
brought, the right-of-way remains, we have a right-of-way coming down there on that lot.
Oh, yeah, we have a, yeah, on the, that's not being touched. That, the remnant lot, there's no changes to the remnant lot at all with regard to the right-of-way.
Because that comes down from Bar Drive.
Yes, it does. So that's all there is to it.
Okay.
So they're just exchanging land. They're not building anything.
Correct.
We were talking at one point along the way here about why we have to do this. Maybe you could just touch on that so we all can keep that in our mind.
Certainly. Allegheny County is not permitted to record a subdivision without coming through the municipality where the subdivision is taking place first, if they have a zoning and planning ordinance. If not, now that the county has their own subdivision ordinance, they have to follow the county subdivision ordinance if you don't have a subdivision ordinance. So this is, our procedure is that they have to come through town council and be finally approved by town council after they're recommended one way or the other by the planning commission. So it has to go through a formal process in the town of McCandless prior to it being recorded.
Thank you, Bruce. Does anybody else on council have any comments they'd like to make? If not, is there anyone in the audience that would like to comment on this action, proposed action? Okay. Mr. President, in light of that, nothing further to report, to present under the Zoning and Finance Committee.
Thank you, Bill.
Mr. Chairman, I'd like to call to order the Finance and Personnel Committee. Reports by Manning and Napier and Anco Consulting, formerly Bogdan Group, on the investment performances of the uniformed and non-uniformed defined benefit pension plans. I'm going to refer to Justin Lauder and David Eminem. Justin? Okay.
Yeah, I think I'll start off.
Evening, everyone. I think Joan mentioned the name change, so it was a name change only. You probably would have received notice at some point late last year. The name change occurred on January 10th. No change in ownership. Really, we just wanted to sort of reflect a new name going forward, as Joe Bogdan, the founder of the firm, had retired about 2 years previously, so we thought it was a good time to sort of move forward. And the logo on the front cover, we hope will turn it into our Nike swoosh. So, are there any questions on the name change? All right, great. What I wanted to focus on a couple of things. One was a fourth quarter review, a review of the police pension plan through 2016. I then have a one-page update for the plan through February, and then another one-page preliminary update through March. I'll turn it over to Dave then. I think he has a little bit more detail on the first quarter activity. But I wanted to start with the fourth quarter in 2016 for the police pension plan. And in our quarterly report, if you wouldn't mind opening up to page number 2, I might focus a little bit more on just broad market activity than usual, because I think it sets the stage for performance for Manning and Napier and for the pension plan. So on page 2, excuse me, and I'll start with just looking at some of the one-year performance. I really want to focus on the fourth quarter, but for the one-year time period or calendar year 2016, again, lower right-hand side of the page, page number 2, if you look at the index returns, excuse me, in red, so these are international equity indexes. Developed international equity markets 2016 returned 1%, so a slight positive. You can see that with the MSCI EFA index. And then emerging markets returned 11.2% for the year. Quickly looking at U.S. markets, it was a good year, broadly speaking, for the U.S. markets. The S&P 500 returned 12% for the year, and the Russell 3000 returned 12.7%. Small caps, which is based on the Russell 2000 index, small caps led in the U.S. with a very robust 21% return for the year. And when we look at our fixed income returns, we usually focus on that Barclays U.S. aggregate return. So that's going to measure broad fixed income activity in the U.S., returning 2.6% for the return, although noticeably it was negative in the fourth quarter. So what I want to do is spend a little bit more time looking at the fourth quarter, looking at some of the market activity in the fourth quarter, and trying to sort of tie that into the Manning and Napier portfolio. And then obviously Dave can piggyback off of some of my comments. But if we look, so more top right, and we have the quarterly performance. I'm going to start with the fixed income. So those are the benchmarks that you see in green. And again, the Barclays US aggregate being our primary fixed income benchmark. You'll notice it declined 3% in the fourth quarter. Bond yields rose, which led to depreciation for fixed income holdings. The Federal Reserve, you've probably seen that they've been in the news with what they're going to do with interest rates. In December, they actually increased rates, but at the same time in the fourth quarter, the market was assessing the Trump election win, a lot of which the market thought pointed towards increased economic growth, whether that was through fiscal spending, tax cuts, or just deregulation, as well as the potential for higher inflation moving forward. So a lot of that put a lot of pressure on rates moving higher, and interest rates and bond prices have an inverse relationship. So when interest rates move higher, typically you're going to see decline in bond prices, and that's exactly what we saw in the fourth quarter with that negative 3% return for the broad fixed income market. And actually, if you owned a 20-year U.S. Treasury bond, you would have lost 12.2% in the fourth quarter. So it's just a reminder that fixed income, while it's not as it's certainly not as volatile as the equity markets, it is not a risk-free investment at times. And fixed income can decline over short periods of time. We saw that in the fourth quarter. I'm going to focus mostly on the U.S. equity market returns. Really, I'll move on then to how that relates with Manning and Napier equity holdings. But U.S. equities positive in the fourth quarter across all capitalization ranges. Again, with small caps leading the way in the fourth quarter. The Russell 3000 returned 4.2%. And if you look at mid-cap, small-cap stocks, all positive as well. For the year, actually, and for the quarter, value stocks significantly outperformed growth stocks. So value stocks returned 7.2% in the fourth quarter if we looked at the Russell 3000 Value Index, whereas growth stocks only returned 1.2%. So we saw a real divergence in performance in the fourth quarter. In terms of sector returns, financials clearly led the way in the fourth quarter with a 22% return. That was triple the return of any other sector. So that was really led a lot by the large banks. Now, financials tend to benefit from the expectation of, one, future deregulation under the new administration, as well as higher interest rates moving forward, which tends to benefit their profitability. So financials did extremely well. Big banks did extremely well. Other sectors that benefited, industrials and materials, these sectors did well as the promise for infrastructure spending sort of brightened their outlook. And energy stocks also did very well in the fourth quarter after a November OPEC agreement to cut supply. Not all sectors did quite as well. Technology was essentially flat, just a slight positive. In healthcare was a negative 4.1%. Uncertainty of future regulations as well as the potential repeal of ACA was a headwind. So not all stocks, while the market broadly did quite well, not all sectors, not all stocks did, benefited, I think, from the sort of tailwinds that we saw broadly from the election. Now, if we looked at the Manning and Napier portfolio, one, looking at their equity portfolio, it is a fairly concentrated portfolio, so really about 45 individual stock holdings. And their portfolio will diverge significantly at times from the benchmark sector weightings. So think of it, Manning and Napier doesn't invest like the index. So often you're going to see a return pattern that doesn't look like the benchmark. Now, Recently, the sectors that Manning and Napier believes offers the most compelling opportunities moving forward includes technology, healthcare, and consumer discretionary. So these three sectors make up 68% of their total equity portfolio versus only about 46% of the index. In fact, almost 50% of the equity portfolio, domestic equity portfolio, is in technology and healthcare sectors. Now, remember, these were two of the weakest sectors during the fourth quarter. Not only that, Manning and Napier had an underweight to the energy and industrial sector, as well as a very noticeable underweight to financials. Only about 2% of the equity portfolio is in the financial sector versus about 15% for the benchmark. So those big banks that returned 30+% in the fourth quarter, Manning and Napier didn't have any of those in the portfolio. So a lot of setup for what was, really disappointing performance by Manning and Napier in the fourth quarter. Now, through the first 3 quarters of 2016, Manning and Napier was doing very well. Their portfolio, the total portfolio, had returned close to 8% through the first 9 months of the year. Equity returns were in double digits. They were outperforming their total portfolio benchmark, and the pension fund was actually ranking in the top decile of public fund sponsor pension plans year to date through September. On account of fourth quarter performance, and I'll get into the specifics of performance in a minute, but on account of fourth quarter performance, Manning and Napier ultimately ended up, underperforming benchmark returns for the calendar year. In fact, it's the third consecutive year of trailing the index and peer group return expectations for Manning and Napier. However, what I will say is, and I'm sure Dave will talk about this, but many of the themes that really hurt their performance in the fourth quarter significantly reversed to start 2017. So if we just look at equities, technology is leading the way right now. That sector of the market is up 12% through March. Healthcare and consumer discretionary, Manning and Napier's other two big portfolio weightings, up 8.4%. So only the tech sector has done better year to date. Also, the energy sector has declined about 6.7% through March. Banks and financials have cooled off largely. So a lot of the trends that were hurt Manning in the fourth quarter all of a sudden have helped them in the first quarter. So with that is sort of the introduction to the markets and sort of the portfolio setup, specifically the equity portfolio with Manning and Napier. I wanted to look at some return information, but I wanted to touch on quickly asset allocation for your information on pages 3 and 4 as well in the quarterly report. So I'm on page 3, and you'll see the pie chart, hopefully. And if you look at the top right, so in terms of just market values for the police pension plan at the end of the year, $13.9 million. There was a market value decline, you'll see, of $331,000 over the quarter. And then you can see the pie chart breaking out sort of the exposure to both domestic equities and international equities, as well as fixed income and cash. In total, if you were to sort of aggregate up the equity holdings, it's about 56% of the total portfolio, with the remaining 44% in fixed income and cash. And then on page 4, what we're doing is we're looking at the portfolio allocation relative to the policy benchmark and the policy guidelines. So you can see in the policy you have these target allocations, and you'll notice that sort of in the middle towards the bottom part of the page, you can see the target allocation to domestic equity, 40%, international equity is 15%, and then 45% fixed income. There's no explicit target to cash, but there's typically a little bit of cash in the portfolio. And you'll notice in those bars, just a slight overweight target to domestic equity with a slight underweight to international equity at the end of the year. But if you were to sort of balance those out, you'd notice that it's pretty close to the overall 55% equity target, and then a little bit of an underweight to sort of traditional fixed income, but that's offset by the 2.5% position to cash at the end of the quarter. So really what this is telling you, right now Manning and Napier is pretty much in a neutral allocation to sort of the policy targets. And I guess I'll ask Dave to address what that positioning means, what they're expecting, and how that might impact returns going forward with what the market does. But right now, in a very neutral position, but you're certainly within investment policy compliance with the asset allocation currently. A few more pages I'll point out really quickly for you. Page 5. We'll focus. We're going to focus a lot on the quarter and on the year, and we'll look at other time periods. But this on page 5 gives you a good sense of how the police pension plan is done over a very long period of time. So we're just looking at the growth of the fund going back to sort of Manning and Napier's inception back in the early parts of 2003. You'll notice the beginning market value at that point in time, about $6.8 million for the pension plan. Over this time period, cash flow out has been about $1.87 million. And then you can see investment gains over that time period, just shy of $9 million. So that's sort of how we go from 6.8 to just shy of 14 million over this time span, and an annualized return of 7.7% since Manning and Napier was retained. So that's sort of a longer term picture. It shows you the growth of the pension plan over time. And that sort of gray graph is just showing sort of where you would be, if you just kept that initial 6.8 million sort of in the bank, and the withdrawals, the cash flow out would be 4.9 million, but with the investments you're at about 14 million today. So even with all the ups and downs, it shows you the growth over time. Page 6, really just want to touch on a few of the numbers. We're showing you a couple of different time periods here, just the quarter to date, that would be the fourth quarter, and then we have year to date and 1 year, year to date and 1 year time period being the same in this case, since it's a December 31st report. But for the quarter, if we look at the starting market value, 14.2 million, we actually had positive cash flow coming into the police plan for the quarter. Investment returns were actually a loss of about 500,000 for the quarter. So that's how we get the net decline of about 331,000 over the fourth quarter. But if you look at year to date, 1 year time period, net cash flow out of the plan, 182,000. Return on investment here is positive for 2016, about $559,000 for the total market value increase for the year of about 377,000. I'll stop for a second. Are there any questions, council?
Maybe it's too soon to tell and it's too recent, but what about all these acts of terrorism, bombings, and other attacks on the several cities in Europe? What kind of an impact has that had on our international investments?
That's a good question, and I might not be the one to answer that right off the top of my head. But international equities this year have done quite well. And I believe the Manning and Napier international equity holdings in 2017 have held up quite nicely. So I think some of the fear, if you look at some of the what's going on in Europe, and you look at it more of a holistic market sense and going forward, to me the concern is what is the reaction from a nationalist or populist front in terms of elections moving forward. I mean, we have Angela Merkel will be up for re-election. At some point, she's sort of been an anchor of stability during a very chaotic period in the Eurozone. But you also have some pretty extremist candidates that are looking to Marine Le Pen in France. I doubt she'll get elected. She probably jumps out. Everyone wants to close up the borders, or this is what they're sort of want to be elected on. Close up the borders, A lot of it is certainly immigration related. We saw a little bit of this with Brexit and how that vote passed last year, but the concern is that sort of the global economic order is potentially, decaying a bit. That is a significant headwind, I think, for any equity investment, whether it's in the U.S. Or your international holdings. So the markets haven't reflected a lot of these incidents that at some point in our lives we would have thought were pretty extreme and the market would sell off significantly. We haven't witnessed that recently. We've seen less market response to sort of geopolitical risk, and it's, I think it's a concern certainly going forward. I think every one of these incidents, these attacks, it's another little pinprick in sort of the global economic order. But markets have been very resilient all year. So I know that's not the straightforward, maybe a great answer, but maybe Dave can think about that one and address it maybe a little bit better.
You said the economy is decaying. Do you mean the international economy? Or?
I mean more just the established sort of political order more than economically. Actually, we've seen a little bit of growth upside in Europe recently. So economic foundation globally it's not great, but it's pretty solid. France and Germany are doing pretty well. I mean, unemployment is certainly still high in the Eurozone, certainly very low here in the U.S. So I think if you were to look at economies, some have a brighter, picture right now than others. But broadly speaking, I think we're in pretty solid footing, but it's still, potentially, fragile. We don't see a real a recession in any, in the U.S. or overseas in Europe, certainly, where we're at right now. But the markets have been elevated. They've done very well. So equity prices are pretty elevated, perhaps. So the concern, I think, would be that stock returns have gotten a little bit ahead of economic reality. So we might see a pullback in market returns, but it wouldn't necessarily mean that there's anything fundamentally wrong with the underlying picture. I think markets have gotten a little bit ahead of themselves from where we're really at economically, but we're still in pretty solid position, I would say. Not a lot of growth, but there's growth, and I think the downside to a recession is pretty minimal right now.
Thank you.
All right. Well, let's go to page 8. I'm sorry, and let's just look at performance. I'm going to read some. I set this up a little bit, and again, when we look at what we've seen in 2017, the returns are a lot more favorable in terms of absolute returns as well as relative returns for the plan. But it was a very difficult fourth quarter. Now I'm just going to focus on the total fund return right now. In the fourth quarter, negative 3.44%. So that was a decline in investments over the quarter. If you looked at your policy index, which again was just that, sort of 50% equities, 50% fixed income, it would have broadly been flat, actually a slight negative 0.08. And then the public plan sort of median fund, so the 50th percentile fund for the quarter would have returned 0.7% positive. So a very difficult sort of total fund return in the fourth quarter. You can go down the line and see the Manning and Napier sort of segment returns. The equities, negative 3.17 for domestic. The international equity portfolio, which is a much smaller piece, was down significantly. And then fixed income markets were broadly negative. Manning and Napier was negative as well, not down quite as much as the benchmark. And again, those numbers in the parentheses are universe rankings, so it's looking at the portfolio or the portfolio components on a sort of in a universe of similar investments. So that means for the total fund, we're comparing you to all other public pension plan returns. So the rankings are 1 through 100. Unfortunately, 100 is the least favorable peer group ranking you can have for any one time period. So it was a very difficult fourth quarter for Manning and Napier. And then if you go out, and we'll just focus right now on the total fund again, year to date, or the 1 year time period, 4.22%, so a positive return, but the policy index 6.61%. So that means Manning and Napier's total portfolio underperformed by 2.39% last year. And really, I mentioned earlier, there's been 3 consecutive now calendar years in which Manning and Napier has underperformed, and that's reflected in that 3-year sort of return right now of only 2.22% for the plan versus 4.99% for the index. And likewise, the peer rankings reflect that Manning and Napier has had a difficult time over the last few years. Now, when you go out over longer term time periods, 5, 7, 10-year, the returns are much more in line with the benchmarks, but still on a peer group basis, I think from what we had seen historically with Manning and Napier, where your pension plan was often in the top quartile, it just reflects that it's been a very difficult environment for their portfolio. And this has really been the case with really all components of it, both equities as well as the fixed income portfolio. So I'll pause right now to see if there's any questions from council on the Manning and Napier performance through the fourth quarter. Bill.
I recall it, and I'm not sure which meeting it was, perhaps it was just 1 year ago already, where you commented on this very point, and we're critical, and I don't mean that in a pejorative way, of Manning's performance. And there was some hope that that would recover and improve over the following year. Is your bottom line that has not occurred, and that they're still in a position which is not advantageous in terms of their portfolio performance?
Well, the fourth quarter really, it was probably a year ago, exactly. And the fourth quarter performance really sort of skews things a lot, because if we had met a few months prior and sort of looked at the portfolio right before the end of the year, it was doing quite well. Manning and Napier was outperforming. I mentioned through September the plan was in, I think, the top decile. So that just shows you what one quarter can do, and that's one of the reasons why I mentioned that the equity portfolio pretty concentrated. Their fixed income, they're pretty active with how they manage the fixed income in terms of the interest rate sensitivity. So it's a portfolio that I'm not going to call it high risk, but it does have a high level of variability in the return pattern. We've seen swings in performance both to the positive and unfortunately to the negative as well. So to me, if you look at this, I would say the fourth quarter, as of right now, I will call an anomaly, especially because of what we'll see in the first quarter. But their performance in the last 3 years, I don't think we take a pass on their performance. We don't. We can continue to monitor them, but if we see a repeat in a fourth consecutive year, that's when I would be more strongly urge council to work with us to maybe come up with some other portfolio solutions, maybe some diversification. But this is just sort of part of the Manning and Napier portfolio that we've seen these swings in performance. So that's a question for Dave, but I mean I wait to see how things progress this year. But if we don't see, a better 2017, then I think, our recommendation would be, to come up with some potential new ideas.
In terms of portfolio strategies.
Yeah.
Okay. But this is, in the last year, there's real money going out the door in terms of lost opportunities.
Yes.
It's not a theoretical proposition.
Right.
And then you're saying, let's wait another year and see whether it's just as bad next year, and then make some adjustments. Is that what you're saying? If it doesn't improve.
There is upside to this I see upside to the portfolio, and particularly the equity portfolio. I see upside. You certainly, Manning and Napier, Dave will probably tell you that, the opportunity loss, your only loss is capital loss. So it's only when you sell out of a loss, are you truly locking in, that loss. I am more than happy to come up with potential solutions for you to look at in terms of different strategies moving forward. The last time I think we had this conversation, the sense that I had was to focus more on the long-term positives of their performance, and it didn't seem like there was, a great desire to make any changes at that time. So certainly we can, come up with alternative, structures, introduce, the, different components that aren't, present in the structure with Manning and Napier. But really, the direction, we will take direction, from town council. It's just, the last time we met, it was, let's focus on the long term. We're not concerned with, 2 years, but now it's 3 years. So I don't know if that changes sort of the outlook for you or not.
I have a very basic question, and I'm sure I missed this somewhere, I understand that Manning is the investor for the police pension plan, but I don't understand who you are. I mean, it looks like you're in here, you're making lots of comments on this, but you're not this, are you like an auditor for that? But I don't.
Well,
I mean, you gave me anything of who you are. You just said this is the results of it. And can you give me just?
Okay, sure.
Yeah.
I'm many and Bill might be able to add on to anything I say, but it's
Reese.
yes, it's generally considered prudent practice for pension funds, pension plans, in groups of trustees to hire an independent third-party consultant to oversee the pension fund, in addition to hiring an actual professional investment manager. So we put together this quarterly report so you can sort of, has a handful, information, maybe more than you need, to really assess Manning and Napier. And ultimately, we work with town council and we'll make recommendations in terms of how to structure or, implement investment ideas with the pension plan. But we're an independent third party. We're not affiliated or related to Manning and Napier.
Okay, having heard all of that, and then having heard you answer those questions, your whatever this is on page 10 is pretty scathing. I mean, it says, that, are you going to go over that? Or it says that they have underperformed the index in the current quarter, which I realized was not this quarter, but last year, at 1 year, at 3 years, at 5 years, and at 10 years. So
Right.
It doesn't look like it's a 3-year problem. It looks like it has been a very long-term problem, if I'm reading this correctly.
So, one of the things about, when you look at sort of those returns on page 8, so these are sort of a rolling time period, so these constantly change given what quarter, the most recent quarterly activity. So to say that they underperformed the benchmark over the last 5 years, that's a moving snapshot, so it's possible that The prior quarter, if we just looked at that 5-year time period, they would have been outperforming. So if we look at returns as of the end of the fourth quarter of 2016 and look at over the last 5 years, or pick the time periods you mentioned, yes, the portfolio returns were below sort of the benchmark expectations. But that doesn't mean that's consistently or always been the case.
It also said that you recommend that they address their poor performance as well as prospects and time frame for a portfolio recovery to us, and that it sounds like for potential diversification strategies and to reduce the asset exposure. So it sounds to me like you're not happy at all with how the performance is. I mean, that's what I got from this page.
Right.
Is that correct?
That is a fair
Are
assessment.
you giving them a C minus, an F, a B plus? I mean,
I would say throughout the course of their being involved with the pension plan, it is a better grade than C. Recently, their portfolio, their themes, their ideas, it's been a difficult environment for a lot of managers, but they have been relatively unsuccessful with both the equity and fixed income performance. I think part of that, again, with the equities is just the somewhat concentrated nature of the portfolio. So you're going to get these pretty wide swings in performance relative to the index. We see that in the fourth quarter, and you'll see that then in the first quarter. But to answer your question, we have other clients with Manning and Napier, and throughout, every client has a different history, different objectives to an extent, and a different makeup with their boards. But we have implemented some changes to clients that do have Manning and Napier, a portfolio like this, and usually it's been to try to find complementary pieces, or what can we do to perhaps lower the overall volatility profile of the portfolio. Some have looked towards other fixed income managers for their fixed income exposure. So there's a lot that we can do. What in the vocabulary on page 10, yes, 3 consecutive years of what I would call fairly significant total fund underperformance. And I'm just looking at focusing on calendar year performance, which is on page 9. But 3 calendar years, I think it's fair to have your manager that has 100% of the pension fund assets to hold their feet to the fire and say, what do you see? Why has your portfolio, not performed better? And really, realistically, how much longer, if you were sitting at this table, would you give us? So that's, and that gives us a little bit more of a time frame to assess things. And if there is a decision to explore alternative ideas, that is, where we can come in. I can show you what we've done for other clients, but we'll work with counsel how best to proceed moving forward. But again, it's been a tough stretch, but it's been they've done since they've been hired, they by most metrics have outperformed benchmarks and done better than a lot of peers since they were hired.
My question is, though, even though you're saying this first quarter is better, how long do we wait to decide whether we want to make changes, since we've had this history these past 3 years?
And I think, let me just follow up on what Kim said. I think it's a very good question. Justin is here as an independent party who's an expert in investments, his firm is, to sort of advise us who are not professionals in the investment area what we should do with the retirement plan. And I think what Kim is asking for, and I think Joanne's asking for, is it your recommendation that we get rid of Manning and Napier and find a new party now? I mean, we have to rely on your advice in that regard. So, I mean, I think that's the ultimate question, or should we wait, or what is your recommendation? Because that's what we have to
And how
rely
long
on.
do we wait?
Right.
we want our police officers to have the best possible pension. And it doesn't look like that's happening. So we need to know how we can make that happen.
Since 2008, when the stock market was bad, and the governments have been lending a lot of money out, and really the word I have is that index funds have been better than managed funds. They're performed better, and so maybe the trend is changing now. You know, the central bank is not being as accommodating.
Right.
And so maybe we may be making a change just when the economy is changing.
So one of the side effects from, you know, the sort of response to the financial crisis here and globally has been massive amounts of central bank stimulus. And what that's done, and this is something that you know, Dave can follow up on as well, but what we've seen over the last several years is that there's been a divergence between company performance and their fundamentals. So if you were to look at, you know, a financial statement, you know, a company that you would, an investment manager would say, wow, this is, you know, great growth opportunities, you know, low debt, great management team, you know, this is a stock you want to own in your portfolio. A lot of those companies haven't responded. Their performance hasn't been as great as you would expect. And a lot of that has been central banks driving down interest rates. And what that does is it makes debt cheap. So financially weaker companies can borrow, they can refinance their debt. It's a lifeline to a lot of lower quality companies. Now, you're right about the timing. The lifeline could be going away. We've seen some hikes from the Fed, 2 over the last 4 or 5 months, but we're still in a pretty low interest rate environment. So one potential solution, this is what we've done with other portfolios, is it's indexing versus active management. It's not an all or nothing proposition. So you can easily look at different scenarios in which you have, X percentage, we can model things, but of, we'll say, Manning being an actively managed equity manager, then you can slide in an index fund for diversification behind that. So you can still have sort of an active manager trying to make, assessments of what, will hopefully outperform the broad market moving forward, but then you have that diversification piece with the index behind it. So that is a potential solution.
But Justin, not to put you on the hook, because I am, these guys really need the protection of, of you advising them what to do. And whatever that is, if you're saying, get a new manager, do a manager search, or you want to keep Manning in the pier and hire, buy some index funds, I think what we have to look to you to do is tell us what to do.
Suggestions.
Yeah.
Right.
Right.
And
This
that's
is about,
Tim saying
This
this
is
language
about
on
the third
page
time.
10
It's
is
very,
pretty,
it's very
Manning
strong.
in the
It's very
Pier, I
strong.
believe, is the
Well-
third
Very
manager
negative.
we've had.
Let's unpack page 10, I think, is the one that, the narrative on page 10.
Right,
And,
that's what I'm referring
and
to.
you have to, when you look at this, it's, I'm not gonna recite the whole thing, we can all read adequate for it, but it says, the time period and underperformed over the 1 year, 3 year, and 5 year time periods.
Thank you.
That doesn't sound good. You don't have to be a financial analyst to know that's not a good result, right? I mean,
right. Well, I mean, you can see that in the
Well,
those
well, that's
numbers.
what I'm trying to
Those
say.
are just numbers. I mean, it's
So
not.
what's causing, and I'm not trying to be smart on it, and it right near the bottom decile of the peer group over a 3 year period. What's causing, why is that happening, I guess, with lack of a more sophisticated way of identifying it, because it goes down below, and when we talk about that last paragraph, kind of spells it out. Is there something that Manning and the peers not doing in retrospect that they should have been doing in terms of their decisions, their investment decisions?
That's a question more adequately addressed by Manning in the Pier. What I've seen is a portfolio that's relatively concentrated, which is over many, at many points in the past has been a benefit, but you're seeing sort of the downside to a sort of a concentrated, more volatile equity portfolio when it doesn't perform well, as what we've seen over the last few years.
Let me back up for some basic information that I think may have been sort of requested by the questions that have been raised. As I've always understood it, there are three sort of basic groups that are involved here. Your group,
Right.
and your group is sort of an overall guru of investment strategies. Is that fair to say? Or can you capsulize what your group is supposed to be doing?
Their job is to oversee the manager that we hire and make sure they're performing properly, and give us advice whether we should retain that manager or get rid of that manager.
Just evaluate Manning and Peer in this case.
Yeah, they're giving you the fiduciary protection you need, so, that's why I think, we need to have a recommendation. I don't know if you're prepared now, but I think this has to be addressed, because we have this sitting here, and we wanna protect our police pension fund in the town, and, if it's really bad, then maybe we should be doing something about it. If it's, this is only a temporary type of thing in your opinion, maybe we don't, but, I mean, eventually, we need to have some advice on where we're gonna go with this thing and what we should
That's
do.
what my-
I think that's
my
what your
question.
last sentence says in your paragraph, in your report.
Yeah, I believe when we discussed this in the past, that I got a sense that it was a bit premature to even consider, a world without Manning and Napier. Now, the fourth quarter has altered some of the trailing returns. But yeah, the last paragraph is, yes, we will provide recommendations. What we would prefer to do is actually put together an analysis, sketch out some alternative scenarios, so you can actually see what that might look like. And it sounds like there's enough interest from the group that, that would be the next step, and that would be, our recommendation. And
The concern, I think everybody on council who has responsibilities for directing the overall effort, I don't want to be sitting here a year from now and saying, gee, things have gone further into the tank. Why didn't you make some recommendation? Or what is it you should have done? That's the concern. Is there something we should be doing now before things get worse, or is this a temporary situation?
I mean, my first recommendation, again, is to explore diversification with multiple managers, so that you don't have 100% of the pension with Manning and Napier. The next step is to assess if, Manning and Napier is still a right, fit anywhere or overall. But I think multiple components, so you don't rely on the performance of any one manager, which is an idea that, we thought about exploring in the past, would probably be the most prudent first step.
Well, in the past, I think one thing everyone should keep in mind, like 10 years ago, 15 years ago, it wasn't big enough to have multiple managers. But now it's grown, and I think that's certainly something that could be considered, because it's a lot bigger now.
It's still on the low side of being big enough.
Yeah, it's not, but I mean, you still could do it at this level.
Just
10
saying,
million
it's my
is usually
opinion.
where I see it, but.
But
anyway,
we
that's
talked
their
about the
question.
last
His
time
boss-
you were here,
His
Isn't
boss.
this-
but we haven't done anything.
I know, I got,
Justin, isn't this kind of like chasing a hot stock, though? Well, why don't we, just because Manning Napier had a soft year, or 3 quarters, or whatever, now we're gonna go with Parker Hunter because they made 10% last year? Isn't that kind of similar? I mean, to say if we're gonna dump Manning and Napier and go with Parker Hunter because you know what they say in every investment, past performance is no indicator of future,
Yeah.
Whatever. You know that routine. So isn't it sort of like that?
there's an element, and that's why I, especially when I talked about the equity portfolio, there is upside. And that's why I wouldn't necessarily say, replace Manning and Napier with with another manager. It would be, let's put together, a study or a piece. let's break out each component of Manning and Napier's portfolio, and let's find something that will either complement or potentially replace that component. So the solution isn't necessarily get rid of Manning and Napier. It's what are they good at? Where do they struggle? Where can we bring in other managers or funds that can put together a total portfolio that makes more sense from a risk and a risk adjusted basis. So you're right, and I think that's the dilemma of having all of the assets with one manager. If it was a multi-manager model, there would be concern with Manning and Napier, but it wouldn't be such a pressing issue, because it would be if they only had half of the equity assets, it would be a quarter of the portfolio struggling, but you would have other components that perhaps would be doing better. So it's always prudent to pursue diversification. In this case, it might also be prudent to retain Manning and Napier in a few places.
So basically, you're not giving us an answer.
That's right.
At
Can you
least
put
that's
a,
the way
can
I
you
hear
put a
it.
plan together and give it to us? We can look at it, we can try it for a year. If things don't perk up, then we'll do something else.
I'd like to ask a question, if I may. How, the monitoring charge that they levy for their services, will that cover such a plan?
A search and a sort of.
No, not a search. I don't think anybody's asking for a search. I think people are asking for a plan. So your monitoring fee covers certain tasks. So before council
It will cover.
wants to authorize you to do some more work, make sure they know if they're already paying you to do that work, or if you're gonna charge them extra.
It will be,
In simple terms.
it's included.
Okay, thank you.
Okay.
I would like to see what the
Yeah,
police
I-
have to say about it for starters, and then after that, I have two questions.
Chair,
Yeah.
Can
chair's
we do that?
prerogative. Your prerogative.
I would like to
Chair's
see what
prerogative.
the
Chair's
police
prerogative.
have to say.
Can you,
I have a question.
can you
Brian.
wait until, can you
Let
wait until
Brian
the end
have
of the
the-
discussion here?
Absolutely. It was
I'm sorry.
it was pertinent to that, but
Well,
Yeah, can we?
your call.
Go ahead.
sir, in your expert opinion, simply, could we be doing better than we're doing?
Over the last 3 years, would you be better off under another structure or other managers? The answer is yes. Does that mean the next 3 years moving forward?
Certainly, there are no guarantees, but
Correct.
this is saying that over the past 7 to 10 years, we've been underperforming. So, am I correct in saying that we could be doing better with some other
And all,
strategy?
yes, that is correct.
Okay.
Could have done it.
Can you help us find that strategy?
Yes.
Perfect.
But I mean, it's not a thing you just, at a meeting, I
Obviously not.
come up with a plan, meet with you, review it first, and then.
As I told you, this is the third manager we've had.
Second.
Manning appears.
Right, but it's the only one we've had since 2003.
We had Mellon in this one.
We had Mellon before him, and we had Continental.
Right, but
before
since,
that.
but you guys started, or Manning and Pierce started in March 2003.
Right.
And it looks like they did fairly close to the Dow Jones Industrial Average until somewhere around 2007, and then it looks like they continued with nearly the exact decline during the crash of 2008. And then it looks like since the crash, they've gone up only about 90% of the Dow Jones until January of 2014, where they've virtually flatlined between now and January of 2014. What did they change in 2014? That they were doing 90% of the Dow Jones Industrial, and then all of a sudden went to nothing. I mean, if you look at the 15 or the 10
I know
year,
what you're referencing, okay.
it's almost identical until here.
Yeah, a couple things. Keep in mind, the Manning and Napier portfolio is not 100% equities like the Dow Jones, so it's
I get that.
it's about 60%. It's specific, and I don't know the dates, but prior to 2014, Manning and Napier was a privately held company. There was, they did go public. There have been over, recent years, some portfolio manager retirements, not necessarily, departures or people leaving the firm to pursue opportunities, but the head of fixed income did retire recently. So the firm grew tremendously overall because of their tremendous track record for several years. They were an excellent manager. Their assets, they continued to attract attention, and their asset base grew significantly. We've seen that at a firm level come down now over the last several years. So, it's a firm that had a very strong track record, that had virtually no professional turnover for a decade, maybe even 2 decades. A very stable firm that, they're going through a difficult period over the last few years. So again, the diversification is in my mind the prudent first step, and to see if there's other elements that can be added to the pension fund, other ideas, but as for what's changed at Manning and Napier, I mean, they've gone public. Some personnel's retired, but that's, Dave would know the specifics of the, what's happened at the, at the firm level more than I would.
And that all happened at the beginning of 2015?
Some departures were around 2015. Their team managed portfolio, so I wouldn't attribute any one person's departure to any performance pattern. They've been public they were public well before 2015. It's a portfolio that it's been a difficult environment for a lot of active managers. Their positioning hasn't, helped in the early part of, a year ago. You saw sort of certain sectors that were probably overvalued by most investors' perspective, like utilities and telecom. Manning and Napier's fundamental sort of process doesn't allow them, it steered them away from sectors and that have done well. We've seen some of that reverse recently, but to pinpoint one specific thing that happened, at the start of 2015, I can't. Nothing jumps out in terms of something that's happened at the firm.
So what you're saying is their problems at their company are affecting us. Is that what I'm understanding?
I think the typical response for a lot of institutional investors, whether it's correct response or not the correct response, when you have changes at a firm level, whether it's senior personnel or portfolio managers leaving, whether you have other investors taking assets away from the manager, and when that's combined with poor performance, the typical response from investors is usually, to make a change.
Well, I just think, just commenting as counsel, I mean, this language kind of puts counsel on notice that they have to do something, and we have to rely on you to give them a recommendation on what they should do. And, I think that's the plan you're talking about putting together.
Right, that was the
coming back.
recommendation. It doesn't even mean you make, a change, and it'll be, you'll assess the pros and the cons. We'll assess the pros and the cons of any change.
So is that what we agreed on? You put together a plan and come back in how long?
It's your timetable.
Well, what's
We
the
would
reason?
like suggestions
Monday?
from you. I feel. I think we need some suggestions from you.
He's gonna put together a plan.
Can you do that for us?
Yeah, probably more than.
You seem hesitant, why?
I think he's trying to figure out how many weeks or.
Oh,
other
time
client-
frame,
other
is
clients-
that
Yeah,
what
I
you're
was
working
trying to
on?
think of
Okay,
the
okay.
time.
I'm sorry, I
Reasonable
just,
time frame.
sometime June, is that reasonable?
What?
To come to this meeting in June, maybe?
Oh, that's fine.
That's
And
too
get
much.
us,
That should be
get
enough.
us a plan before that so people can look at it?
That's fine.
Is that all right with council? I mean, I'm just
Well,
throwing
that
that out.
plan's gonna say something like, right now, we're doing X, we recommend you do Y. I mean, but is it gonna be the, I guess it could be as extreme as changing the manager entirely, or is some approach that the manager's using, or what kind of a proposal can we, in general, could we expect?
What I would do, this is what, if you wanna put me on the spot, don't hold me to this in a month from now. If I was gonna do something, it would be to retain Manning and Napier to manage domestic equities, but take a little bit of that allocation and put it in a Russell 3000 or some form of an index, just a small allocation just to get broader diversification with the equities. The equity portfolio has upside, and like Ralph said, there are reasons why you don't necessarily, why just constantly rotating through managers or different styles, it typically over the long period of time doesn't always work. So the recommendation would likely be pare back Manning and Napier a little bit on the equity portfolio, complement them with an index. It'll help reduce costs that way. I would hire a separate, we'd probably do a lot of this through mutual funds, just because it's really the only way you'll be able to access a lot of this. I would recommend a separate international equity manager. I would not have a domestic and international equity manager being the same. And I think there are probably better fixed income alternatives. And depending on you could, if we look at different funds, and depending on the risk profile, low risk, moderate risk, higher risk, you can even have, you can 2 or 3 different, fixed income components.
Under these remarks you're making right now, which are not a plan, these are thoughts, I would hope.
Yes, I'm just,
Okay.
because I seem to be getting,
Who's making all these decisions that you just laid out?
I would, any of the underlying component changes would be managers that have been vetted and approved by our research group. And then in terms of the portfolio construction, that's something that I would propose. I'd propose the managers, but ultimately, I don't have discretion to implement any changes. I'm happy to make recommendations and give you the thoughts behind it, but that is something that council would have to ultimately, approve.
Well, I think that's all we're asking is for some suggestions.
Right. Was that the question?
Yes.
Is council in agreement with that?
I
Let him
think
study it.
as Bill has articulated, I think we have to do something. I don't think we can just sit here and do nothing. That's the trouble.
There's
And,
a question back there.
yeah.
Well, discussion takes place here first,
Right,
and
yeah,
comments at
we'll
the end.
take comments later.
There's a time for comments in our
Yeah,
procedure.
yeah.
That's later.
Okay, well, that's my view. I think we ought to come up with a,
Okay.
2 months.
Yeah, any other comments from anyone on council?
What do you think a small percent is? When you keep saying take a small percent out and put another, do you think that's 10%?
I think
That
that'll
is
be
a
the
problem,
plan.
because that means who is telling the manager to take X number of percent and put it in a specific fund or group of funds? You said you don't, we know you don't, because you monitor performance. That means the fiduciaries do. Council's gonna be deciding that X number of dollars or X percentage is gonna be distributed amongst certain managers.
We can make that
Recommendation, but they're gonna make that decision. And so that how often is that supposed to take place? Because with an active manager, I'm not lobbying for anything particular, I'm just trying to vet facts here. And an active manager, which was the initial step that council took whenever, I think 13 years ago, I think it was, was switching from Mellon Bank to an active manager like Manning Napier. The idea is that the manager studies the market and makes selections in all sectors, and based on the guidelines the council, the rough guidelines that council establishes as to how much could be put in stocks at any one time, how much domestic, how much fixed and so forth. So if I think he should contemplate, Justin should contemplate whatever he wants to think about and recommend to town council, whatever he wants to recommend. But I think I would suggest that that's where we stop now, tonight, because
Right.
he's trying to give you answers, and he has.
Off the top of his head, and that's
he has a
not-
rough game plan, I think,
Yeah.
in mind, he's already
Okay.
said that, but I think it's only fair to all of us that he, think about this, talk to colleagues, I'm sure there's other people on the Bogdan, or the now ANCO team, that are gonna be brainstorming with him, so that he comes back with a fulsome, set of recommendations or alternatives.
Would it be useful to hear from Dave before we quit on this effort today? I mean,
How about, he has two other performance, segments of performance, the two most recent months that are in your packet, correct?
Right.
I thought we ought to at least hear about that for about 2 minutes. And I
Let's
think-
re-
I think
let's
that
le-
Mr.
let's review that.
Mr. Immonen's prepared.
So included with the information was an update through February and then another individual update through March. The update through March was a little preliminary still. So I'll focus on February performance update.
Justin, could you identify a little more particularly what it is you're talking about when you're talking? I think we're shuffling these papers around, and I tended to lose track a little bit about what, if you're going to be talking about a piece of paper, how about identify for us which one you're talking about?
Upper right-hand corner, February.
Rob?
Page number.
What page?
It's a
Single page.
It looks like this, Jeff, yeah.
Maybe
It's a separate
attached to another-
sheet.
Maybe attached to one other single page.
Is this it?
No,
Does this begin with this?
no, it's
What's
this.
Let's see, everybody caught up, we got.
Is this it right here?
Yes, sir.
Yeah, it's
Yes,
got the
that's
big
it.
Two-page document stapled
pie
together?
chart on it.
Yes,
Okay.
that's
All right,
it.
so on the front page should be February 28th
I got it.
update. So we'll just focus, more on the year-to-date as opposed to the month February. But the month of February, the portfolio total fund up 2.07%. Year-to-date through February, the total fund, again, the total fund being entirely with Manning and Napier, returned just shy of 6%, ranking in the first percentile of public pension plans, roughly over about 3.2% better than the median pension fund during the first 2 months of the year. That's outperforming the index by 3.64%. If you look at the total fund over the last 12 months, you can see relative to the policy index, a return of 13.14% versus 12.29% for the index. So outperforming the index, the one comment I would have on the 1 year time period, on a relative basis, still sort of underperforming the peer group, and a lot of that is allocation driven. If you look at the lower right-hand side of the page, you can see the allocation, the breakdown between equities and fixed income. If you haven't seen the numbers on this page, equities did significantly well to start the year versus bonds, which are roughly up 1%. But Manning and Napier about 51.8% in equities at the end of February. A lot of pension plans have a more aggressive allocation to equities, 60, 65%. So that sort of underweight to equities, that more conservative allocation right now is a headwind on a relative basis. But if you look at Manning and Napier's performance through 2017, you can see a very strong reversal. Again, a lot of what didn't work in the fourth quarter worked in the first quarter, or worked in the first 2 months, and in fact the first quarter of the year. Domestic equities up 11% year to date. That compares to a Russell 3000 benchmark return of 5.67, so that's 5.3% outperformance. The international equities up roughly 8%, so about 2.75% outperformance with that piece. And then the fixed income positive 1.04, slightly ahead of the Barclays aggregate index of 0.87. And then just looking quickly at year-to-date, that financial reconciliation. So we have investment gains for the first 2 months of the year of $828,000. The pension market value went from 13.9 to 14.66 million over the first 2 months of the year. And then the second page is just, we don't have the sort of the peer rankings on the March 31st update, but the total fund for the month outperformed sort of the policy index slightly. And then you can see the year-to-date return, 6.55%. And then you can see the underlying segment returns as well, with the equities still doing quite well, and an additional roughly 80,000 of investment gains in the month of March. So just shy, a little greater than 900,000 of investment returns in the first quarter, offset by 147,000 cash flow out.
That's for pension payments, right?
Yes, or in some expenses.
That's some
but
expense.
yes. Yeah, it's essentially just benefit payments.
Any other questions from council? Okay, thank you.
Thank you.
Mr. Immonen's next. Mr. Immonen is next.
Yes. No, the comments are at the end.
Okay, right, yeah,
And Mr. Dave?
Okay.
Thank you for the time tonight. I want to start off by coming to Justin's defense a bit, in that it was a year ago, about this month, or maybe previous month, that he also came in with fairly strong language that said, you know, Manning and Napier has underperformed for 2 years, and you might want to consider diversifying some of your assets away from them in one way or one fashion or another. And the remarks were generally about, hey, isn't this kind of like, you know, selling a or buying into a hot stock right at the top, or selling a stock right before it turns around? And so I think he, you know, because I think he backed off on making those recommendations and preparing those kinds of reports. And what I would like to say is that, yes, a year ago we were in a fairly similar position with underperformance. We've now had essentially, you know, 4 quarters, 3 of which were good to very good. In fact, this first quarter, as you just heard, was exceptional, first percentile. Third quarter of last year was also very good. And what I would like to do is spend a little bit of time talking about what happened in the fourth quarter, and then talk about, you know, where we're looking, what we're seeing in the markets today, and why we're positioned the way we are, and why that's led us to success in the past. I apologize that it's so late that you know, that our performance has led all of us to be here longer than we want to be, but I appreciate the time and the opportunity. So, in the fourth quarter, in general, as we've talked, as I've been consistent for the last several years, we believe that the economy has been, and it has played out to be true, that it's been stuck in a rut. It's been very low economic growth. We did not see any much of a way to get out of that. We continue to believe that that's generally the case, that economic growth is going to continue to be challenged, and that while it's been 7 or 8 years of recovery from a devastating credit and financial crisis in 2008, 2009, we are now clearly in one of the longest bull markets and one of the longest economic cycles that we've been in since the end of World War II. We're going on 8 years for both the bull market and the economic cycle. That's the second longest bull market and second longest economic cycle since the end of World War II. So in our minds, in our approach, that's a time to be very cautious, because at some point, we're not ready to say that we're at the end of the game, we're at the end of the cycle, but at some point, we are certainly in the latter stages of the cycle, the latter innings of the cycle, and usually cycles, end up with a pretty difficult situation. We're not seeing anything, and I agree very much with Justin's comments at the beginning. We continue to believe the economy is in relatively good shape. We, in fact, are seeing very good signs out of Europe and China that their economies are recovering from where we were a year ago, where everyone was worried about Europe staying stuck in a zero growth or negative growth range, to where they're starting to catch up a few years behind the United States, but seem to be making very good progress. A year ago, the January of 2016, the markets dropped about 12% in the US. The primary reason being fear that China was going to have a hard landing with their economy. That did not end up to happen, and their growth numbers are starting to tick back up again. So we see those as positives, but not changing the broad demographics or the broad issues that will cause the economy to continue to have struggle to get growth much more than the 2 to 3% range that we've seen it in for the last several years. The biggest issues are demographics, with US population, Japanese population, European populations all aging. And in this country, the baby boomers are hitting retirement. They're starting to pull out of their portfolios instead of putting into them. And they're starting to move to a reduced spending mode from a increased spending mode that they had been in, that drove the economy for many years. So in that environment, we had built a portfolio that we thought, and we continue to think, is well positioned for the latter stages of a bull market, where growth is challenged economically. And, as Justin mentioned several times, it appears that the stock market is fairly expensive. And that a combination of looking at the economic overview of continued relatively low growth in the latter stages of a cycle, where you have to be very careful about what might really take a hit if the economy were to back into recession, or the market were to get spooked and panic. We need to be very careful about what we own. We believe in that environment that the best valued stocks, the stocks with the best opportunity, are actually companies that are producing growth that's independent of the economy, that can continue to grow at 4, 5, 6% or higher rates of growth, and that are trading at reasonable prices. That has been where we have our portfolio. As Justin mentioned, our biggest sector allocations are in information technology, healthcare, and consumer discretionary. It also means that we have a very low weight, or relatively low weight, in cyclical industries like financials, industrials, and commodities and materials. So, reversing back to through the third quarter, the first 3 quarters of 2016, we had a return for your pension plan that was in the top decile, that was beating its benchmarks, that on a 1, 5, and 10-year basis. The 3-year number was still challenged by a difficult latter half of 2014 and early half of 2015, but was showing improvement, as Justin had identified a year ago. There were issues with Manning and Napier. Let's wait and see what kind of improvement we were seeing. So we were showing very good improvement through the third quarter. Then the election happened. And the election was a very, very unusual occurrence. It was a shock to a lot of people in all areas. While the perception was that the stock market was off to new heights every day since the election, from early November through the end of the year, as Justin pointed out in his independent third-party approach, the sectors that really took off were the cyclical sectors, the financials, the commodities and energy, and industrials. Again, those are areas that we did not have much exposure to. Fixed income faced big challenges because interest rates rose quite a bit. As Justin noted, our fixed income portfolio did fairly well in that rising interest rate environment. We've had a position in the fixed income portfolio for several years now that we thought that the danger for fixed income investors was for rising rates. Those rising rates didn't approach until more recently, but eventually they did, and our positioning has helped protect the portfolio. We have we have some international investments, although we're very modest in international, right alongside a policy. International stocks did poorly after the election because the dollar strengthened. So we were very frustrated in November and December. Not only did we not have exposure to areas that were running very, very hard, the stocks that we did have exposure to actually went down. And that didn't make a lot of sense to us, because when we looked at it, we see things about the Trump administration and the election that should be relatively good for the economy if the administration is able to achieve a lot of the pro-growth policies that they have been proponents of. Justin mentioned them. The infrastructure spending, talk of $1 trillion of infrastructure spending, the deregulation, and the particularly tax reform would be a very good thing. Make the economy more efficient, particularly for companies in our portfolio. We did a lot of analysis about that, looking at what happened right after the election. And there's nothing about what we owned in the portfolio that shouldn't have benefited from those same policies. And yet, in November and December, the market was so singularly focused on trying to chase after those areas that everyone thought were going to improve the most from Trump's policies. And we would agree that financials had a fairly good opportunity to leverage several different factors in the Trump administration's proposals. But we did not chase after those returns. That would be a mistake. We remained patient. We looked and bought more of some of the companies that didn't do so well that we liked, that we thought should have done better. And sure enough, as patience allowed us to see what's happened, those sectors and the stocks in our portfolio have done exceptionally well in the first quarter, rewarding our patience and not panicking in the midst of what was happening in that environment. So where we stand today is then what I think from a year ago to today, we've put together three out of 4 good quarters. Yes, the one quarter was disappointing, and it did set back the whole calendar year, which then makes it 3 consecutive calendar years of performance. But had the election happened a month or 2 earlier, we would have already recovered by the end of the year, and the calendar year wouldn't have looked so bad. So it's to some degree, it's a little bit of a matter of timing. I urge you to be patient. I think we're continuing to see very good promise for the positions we have in the portfolio. And let me remind you that, actually, I think one of the really strong aspects of the first quarter's performance is that you achieved a return of 6.56% for the first quarter.
Who are you reading from?
I'm reading from page 7 of 17 of our report.
March 31 report.
The March 31 report, which would be this colored
I'm sorry, what page did you say?
7.
7 of 17.
7 of 17. So we achieved a return of 6.56% for the quarter.
Excuse me, I'm still trying to find page
Yeah.
7.
You're in the ANCO report. You need to be in the Manning and the Pier.
Yeah. You need to go
Oh, I
on.
need that, switch gears on that. Which one?
Looking for this one?
That's the one, that's not,
Nope, not that one.
not that one,
Not this one.
this one?
There it is.
There it is. Yep, page
I'm looking for
Seven
number
of
7.
17.
7 of 17, that right there?
Yep.
Okay, thank you. Thanks for your patience.
Okay. So on page 7 of 17, you'll see that your account return was 6.56%. You know, the benchmark's returns were 3.4, 3.8%. I didn't actually look up, Justin, you know what the S&P 500 did for the first quarter? It was about 6 or
5.5, 6.
yeah, so your portfolio achieved a return that was equivalent of the stock market as a whole, despite the fact that the portfolio only has 52% of its assets in the stock market. And throughout that first quarter, we continued to sell and trim down our equity allocation as equity grew. Because at this point in the market, we are balancing a very difficult environment where we think that there are three things that we track when we look at stocks versus bonds. The first thing is valuation, and we've been saying for 2 or 3 years now that stocks are expensive. The only measure of stock valuation that isn't expensive is when you look at stocks versus bonds, because bonds have such low yields. But stocks have been fairly expensive for a number of years now. They're getting a little bit more expensive. Valuation, like expense of stocks, is not a great short-term indicator. Expensive stocks can get more expensive. And if you saw some of these same indicators that we were seeing reach levels that we saw last year or so, the last time we saw them reach those levels was in 1996. And if we had used that as a signal to say, let's get out of stocks, or let's go to the minimum weight of stocks in 1996, we would have missed 3 of the best years of the stock market, 97, 98, and 99. However, it was a pretty good indicator that there was trouble starting to brew. So we've been monitoring the stock valuations for a couple of years now, and Ben, it's a yellow flag for us to start being very cautious about our equity allocations. If your account can be no more than 70% in equity. 8 or 9 years ago, coming out of the recession and the financial crisis, we were bumping up against that limit because stocks were so cheap, and we felt that it was important to have as much exposure there as possible. Now, 8 years later, after an 8-year bull market, we have slowly moved the equity allocation down almost 20 percentage points. That's one of the reasons why you hired us in 1993 or 2003, was that in the late 90s, we had also seen trouble brewing. We had moved completely out of the information technology sector because that sector did not make any sense to us at all from a valuation perspective. It hurt for a couple of years in which we had relative performance that was on par or much worse than what you're seeing today, where we underperformed our benchmark in 1998 by 10 percentage points. But clients who stuck with us through that time period and allowed it to play out were very, very happy. And in fact, that's one of the reasons we were recommended to you to look at when you hired us. So I guess what I'm saying is that we believe that we're positioning the portfolio in a way that is cognizant of the biggest danger, which is running into another 15, 20, 25% drop in the stock market, where we have traditionally provided significant value added and protected capital in those markets and made up for a few years of, a few percentage points of underperformance as we've seen the last 3 years. I'm not saying that we're happy about our performance over the last 3 years. There were some areas that we have admitted we could have done better. One of the areas, Steve, when you were looking at that chart, it started in June of 2014. If you looked at our performance as of June 2014, we were outperforming over every single time period, 1, 3, 5, and 10 years. 6 months later, we had a slight overweight to energy as oil prices started to fall. And not only, it was a slight overweight, so it wasn't that critical. There were a lot of other managers in the same position. But it was an area that we looked at the end of that year and decided that if we had been following closely our procedures, that we should have been much lower weight. We should have been moving out of energy a lot earlier. We asked the energy sector leader to resign. We reevaluated some of our processes to understand what led to that poor oversight of those decisions. And we decided that our committees had gotten too big, and that a strong personality like that gentleman who had been for the firm with 14 years and had been one of our best performers over those time periods might, could have, we let his arguments sway and hold off the decision to start pulling back in that area. But that wasn't the only issue, and that might have helped a 1 or 2% performance over that time frame. Other issues were that we were lower in duration or very conservative in our fixed income, anticipating eventual rise in interest rates. Interest rates stayed steady or fell over that time frame, and that's a 40% part of your portfolio where we underperformed by 1% or 2%. We have no regrets about those decisions we made on that side. We felt that was the right thing to do. We still continue to think so, although we backed off that a little bit. With the spike in interest rates around the election, we did take advantage of that and sell some of the tips that we had that did very well when interest rates went up. And we extended our duration a little bit, so we're not quite as extremely low duration as we were 2 or 3 years ago. So we believe we've been making the adjustments that are necessary. We understand that it's putting you through a period that's trying your patience, and I believe that part of Justin's report today was indicating you should hold our feet to the fire. You should listen to us for our explanation for why we've had a 3rd consecutive year of underperformance, and you should take that into account as you make your decisions. And I appreciate the opportunity to allow me to make those arguments. And the last thing I would say is that, Justin and I and some of his colleagues at his firm have a number of different relationships that have gone through similar kinds of gut-wrenching analyses and decisions and presentations. And in a lot of cases, they have the conclusion has been reached to split up some of our assets and move them into buckets as Justin preliminarily suggested. What I would make sure that you are very careful about thinking about is that that then removes the asset allocation decision from an investment professional like you've designated to us, where we're an active investment manager. Not only do we actively select stocks that we think will beat the passive benchmarks, but we make decisions, as I've just walked you through, about the asset allocation as a whole, where we've gone from 70% equity to 51% equity in the last 4 or 5 years. We believe that adds a significant amount of value over time, and particularly at critical junctures that we think are coming closer now. I cannot see the future. I can't tell you that it's happening this year or next year, but our indicators, in addition to valuation, in addition to looking at valuation, the next indicator we look at are sentiment indicators, where generally speaking, if sentiment is high, if expectations are high, that's a warning sign for us. In the late 90s, for instance, it wasn't uncommon for your neighbor or your taxi cab driver or the guy at the coffee shop to tell you about some great stock that he's been invested in that has just made, doubled its, tripled its value, and that you should be looking at it. Those kinds of, that's an indicator of sentiment being very high and expectations being very high and everybody being very positive. Sentiment indicators have spiked dramatically at and since the election. They've leveled off a little bit in the last month or so. But of the 3 indicators we look at, valuations have been high. Sentiment for the last 5 or 6 years has been relatively neutral. There have been as many people that are excited about the market as there are that are pessimistic about it. Today you see The consumer confidence surveys have all jumped up dramatically. The purchasing manager, the National Federation of Independent Businesses purchasing manager indicators, these are called soft statistics that ask people's opinions about what's going to happen in the future. Consumers are positive. Purchasing managers are all much more positive than they were before the election. And bull and bear market surveys are showing institutional and individual investors have suddenly become fairly bullish on the market. Those aren't perfect indicators. They don't tell you that things are going to get bad. But what we do say is that if expectations are high, if valuations are high and expectations are neutral, and there's a disappointment in the market, the downside of the market is somewhat capped because expectations weren't that high. But when expectations are high and valuations are also high, and there's a disappointment in the market, it can lead to much more significant downside than in other circumstances. And the third indicators we look at are economic cycle indicators, and for the most part they've been neutral for the last few years, but they're slowly growing. Labor, all measures of the labor market, all measures of inflation, all measures of unemployment are getting to where it looks like the labor market is getting tight. The Federal Reserve is seeing the same indicators and has clearly moved off the fence to a mode of raising interest rates. So we are starting to see the economic cycle indicators get stronger and more difficult, which again tells us this is a time when you need to be careful. And we have a long history of getting those kinds of big decisions right. And those decisions the timing is always difficult. We're not perfect. We got it right in 1987 when the stock market crashed in October of 1987, 25% in one day. And we got it right in 2000 when our equity allocation was only just a little bit lower than it is for your portfolio today. By having absolutely no exposure to technology, we performed significantly better. In fact, for the first 2 years of the 3-year bear market, our portfolios had positive returns. So, but in both of those cases, in 1987 and in 1999-2000, we had 1 or 2 years of very mediocre performance where all of our clients were holding our feet to the fire. Many of our clients did not survive those time periods. They decided to cut and run and move to something else. The clients that did stay with us were very pleased after that. So I appreciate the opportunity to give you that context. I'm trying to do it in as objective as a fashion as possible. I understand the position that you're in. I understand Justin's professional opinion, and I think that will hold a lot of sway with you as well. But I will stop there and leave it open for questions.
Questions from council? I think we're probably waiting to see what Justin comes back to us, what kind of suggestions he brings us.
Sure.
At least that's how I feel at this point. And then we would go from there and decide what we're doing.
And if he comes back in June, you'll have another quarter that you can bring back with you too.
That's right.
Yeah, we're
So-
not,
So you can bring back,
not to be putting you down, but
you
not to
can-
say that we'll go with
you
what.
can-
I was trying to leave it open-ended.
Open-ended, right,
you
yeah.
can bring your quarter
Yeah,
back
so-
with you and
so
we can
you
look at
can
that.
Come back and let us
Thank
know
you.
Yes.
how things are going
Great.
at that point. But we appreciate your coming and giving us the information.
Okay.
And needless to say, you can see why we are concerned.
Understand. You're not the only clients that I'm going through this with, but and you are giving me an opportunity. Some clients haven't given me the opportunity to state our position, and I appreciate that.
Well, I think we're trying to stay
Very-
open-minded.
It's very professional.
Thank you very much for the information and for coming out tonight.
Okay.
Mr. Mr. Chairman, we have a presentation of the town's 2016 municipal annual audit and summary financial information as submitted to the Commonwealth of Pennsylvania Department of Community and Economic Development. This is the basic audit of town funds prepared as required by the town's independent auditors. The town's more detailed annual audit report that meets current governmental accounting standards board requirements will also be presented by the town's independent auditors at an upcoming council meeting after its completion. And at this point, I'm gonna ask Reed to give us some detail.
Just one brief comment.
I'm sorry. Okay.
It's not so much a typographical error, but since I authored this, it's required of the town's independent auditors. In the middle of the paragraph, this is the basic audit of town funds prepared as required of the town. Okay? Thank you.
Reed?
As Councilwoman Powers mentioned, there are actually two audited financial statements that the town prepares each year. The first one is the only one we're legally required to prepare. And it is submitted to the Pennsylvania Department of Community and Economic Development. It's required to be submitted to them by March 31st each year. There is no penalty if it's late, but if it's late enough, the state can withhold liquid fuels monies, which for the town last year was over $800,000 and is used for our paving program. So obviously it makes sense to go ahead and submit that report. The second audited financial statement is the more substantive one. Last year's was over 50 pages. That is the one the independent auditors actually come in and present to council every year. And that'll be presented to council again this year. Looks at this point to be presented to council in May. But we're here tonight because it was pointed out last week that under the town charter, we are required, it says we shall present to town council the audited financial statement by April 1st of each year. And again, the only financial statement we are required by law to prepare is the one that goes to DCED. I hadn't been asked to present that to council in the past because, as the auditors say in their letter, basically, this statement is really only of value to DCED. It doesn't follow generally accepted accounting standards. It's not recommended that anyone who is trying to look at the town's finances as a whole use this as a basis for that. It's simply put in a format required by DCED for their use. But again, because the charter does say it should be presented to council, I'm presenting it tonight. There is an independent auditor's letter on the cover of the DCED report. It discusses management's responsibility and the auditor's responsibility. It also talks about the adverse opinion regarding U.S. generally accepted accounting principles. And again, the adverse opinion is that the state requires we do this in a format that is not accepted generally for accounting standards. Again, it's something that if we were to go to a bank to get a loan, or if we were to send this to Moody's or Standard & Poor's to get a rating for a bond issue, they wouldn't be able to use it. It really doesn't tell them anything. It only tells DCED what they need for what purposes they have. But the auditors do say that based on the fact that this is what DCED requires, this report does present fairly in all material respects the financial position of the town as of December 31st, 2016. So it's basically taking the audited numbers and presenting them in a format required by DCED. Any questions?
Questions from the council?
Reed, you made a point to me, if I may, ma'am,
So,
that we have arrived at a point in your tenure here that you are able to, in the vernacular, close out our books, correct? At the end of a fiscal year?
Right.
So you presented that to council last month?
March 13th, we presented a preliminary financial statement, year-end financial statement that showed actual versus budget and also 2 prior years actual.
Right, which is sort of, can be, which you believe, and I agree with you, step one in our process is to show council where we stood at the end of the year. And then those materials, you closing out our books, readies the auditor then for them to come in and do their work in a very detailed way. And a last comment is that Reach is the first municipal person to be certified with the Government Accounting Standards Board certification. There's no one else in Pennsylvania that has that. And there are two other people. One's a school official, business manager, and one is as I understand it, he or she still holds that position, is in the Harrisburg area working for the Chamber of Commerce. But so Reed's has us well positioned, and he has the auditor well prepared to do their work. One of the key things that Reed's is required to do is perform the management, the MDA, the analysis, the DI,
Management's discussion.
discussion. We get so used to saying the acronym. So he's preparing that and gives that to our auditor. They have to review that as well. So there's a lot that takes place here internally, and then the auditors, of course, their job is to audit and review what he and what Regis helper has done. And so, the auditor seems to be on track to do the very comprehensive report that we've done for many years at the council table coming up in May.
And I will say the auditor called me and mentioned that they always look forward to doing McCandless's because they're always so well done. So thank you for that. Any questions from council? Okay. Thank you, Rich. Okay.
Seminars and conferences you have?
I'm sorry, yes. Number 4, seminars and conferences. Just reminding you that the Pennsylvania State Association of Township Commissioners Conference is June the 22nd through the 25th, and it's at Doubletree in Lancaster. And if you are interested in going, you need to let Marie know. Some of the topics of the program are opioid crisis, medical marijuana, state ethics training, labor law and bargaining, and using drones for inspections. So any of those may interest you, or all of them hopefully will interest you. So please let Marie know as soon as possible if you are interested in going.
And we had I had a notice in my inbox today that there is a dinner, Allegheny County in western Pennsylvania.
Yes.
Were you commenting on that, or did you want me to
No, go ahead
take
with
it
that,
away?
yeah.
They would like an RSVP that you could send to us as usual, our procedure to let Marie know so she can make a reservation for you this dinner. It's a $55 per person. It's Thursday, May the 18th. Reception at 6 p.m., dinner at 7 p.m. We can send the details out to you by email. Magnolia Room Banquet Hall, Freeport Road, Creighton, PA. And so we'll get that information to you in an email. You can let us know.
Okay. Any other comments from council?
And we do have our local opioids town forum
Tomorrow
night.
evening.
All right,
at
reception's at
Community
6:30, and as the program starts at 7, and we expect the speakers to finish around 8:20 or so, and then time for questions and answers from the audience.
And I might mention that at the conference this past weekend, Toby and I gave out literature on it, hopefully creating more interest of other municipalities to attend that.
It's at 6:30, correct?
That's a reception, the actual.
Reception
The
is at
actual-
6:30.
The actual physical location is
CCAC, 3rd floor.
over in the building off of Fairhaven.
CCAC North, right, third floor.
Third floor.
Any other comments?
I may not be able to make that because of a death. I have a funeral to go to tomorrow at 7 through 9. I can probably go a little late. I can make it for the first half hour or so.
Sorry for your loss.
Okay. Any
Joanne,
comment?
one last thing. The ethics reports are due by May 1, so if you haven't finished your ethics report, better get on it right now and get it filed.
Any comments from the audience? Rita?
Yeah. have a question for Justin.
Please come up,
Up on the left.
so you can get on this
Yeah,
TV.
up here?
So you can be on,
Oh, sorry.
this is, since we're televised, your hat at least.
I can't take off my hat, it's bad hair too. Justin, my question to you was, did you ever compare our performance to other, our pension performance for our police officers to other municipalities with a similar amount? Like, is that something you do?
That is something that we do have the ability, and it does make a difference sometimes. We can show you, and I'll add it.
Could I ask you to share the microphone? We're now televised,
Go
you're not, so just,
Go.
either there or, that'd be fine. You two can share the mic.
Since I don't
It's
give
fine.
short answers, the short answer is yes. So we can compare, and I'll add it to the next report, performance relative to other public funds of similar size.
When you start bringing in multiple managers, doesn't our cost go up also? Because each of them has some, some costs, fees that are attached to their particular managing group. So would our fees go up in addition?
Yeah, that's a good question. Typically, because with a lot of manager fee schedules, you get certain breakpoints, so the more assets you have with the manager, you usually get certain fee reductions. So introducing another manager with lower amount of assets, yes, it would be possible for fees to go up. However, I can't guarantee or promise anything. Likely when we restructure portfolios, if it's using multiple typically using mutual funds, you can actually get significant fee, concessions to where you're at right now. So I believe that a portfolio of this size could be diversified, and overall fees would be lowered.
Okay, that's
Interesting.
Thank you. I have a question for you. Most of our assets, or how much is in index funds? Because if you look overall at many managers use index funds, and we seem to perform better than actively managed.
Cheaper.
The short answer to that is that none of your assets are invested in index funds currently. It allows me to point out, I did include in the appendix to our report a 4 or 5 page discussion of active management versus indexing. Generally our view is that it has been 5 or 6 years where all active managers have generally struggled beating passive index investments, but that we've been through this kind of a cycle before. The last one was in the late 90s, which, as I addressed in my portfolio, eventually rolled over and created an environment of 3 or 4 years where active management had a significant advantage over indexes. And what I would say right now is that the difficulty with buying an index today, and what you have to be very careful about, is that you are buying into exactly the market structure that I just walked through, the issues where we have concerns about. You're buying a very overvalued market without any mitigation from a professional manager who might be able to add some value by saying some of the market is overvalued, some of it's undervalued. We're going to have your portfolio in those areas that we feel are undervalued. And as Justin had mentioned a number of times, we're not the only manager who has found undervalued assets that has struggled over the last several years, as the market has continued to favor safer, big dividend-paying stocks whose prices are higher. So, thank you.
Thank you. Anyone else?
I just have a observation that I just wanted to ask about. On the statement or balance sheet should that be the same as the statement as the summary? Because the bottom line figures are different. I wonder, are those supposed to be the same? Okay, there's an excess of $664,507 on the statement, and then in the summary, these summary figures are all completely different from the balance sheet. Okay, two different things.
Yeah, the summary report isn't the balance sheet. It's revenues and expenditures.
The summary.
The summary report shows revenues and expenditures, it's not a balance sheet. So if you're trying to compare that to the balance sheet, it won't match up. Or you're not showing assets here, you're not showing liabilities here, you're showing revenues and expenditures.
Okay, that's simple, thank you.
Anyone else? Did you have something you wanted to say? Okay, that's it. That concludes my report, Mr. Chairman.
You adjourn.
Okay.
You're the chair.
Okay, I adjourn the, no, I just adjourn the Finance and Personnel Committee. Thank you.
Meeting adjourned.